What if I told you that the world's greatest investor, Warren Buffett, still uses strategies so simple that even a teenager could understand? Warren Buffett turned a $100 investment into over 100 billion without chasing trends, without crypto, and without even day trading. Basically, he didn't take any unnecessary risks. So, how does he do it? Why does he only invest in boring companies? And what's the one golden rule he swears by before buying any company stock? Stay with me in this video because in the next few minutes you will discover Buffett's timeless secrets and how you can apply them starting today. Warren Buffett is the richest investor in the world today. He is listed at number 5 in the Forbes list of billionaires. Warren Buffett is nicknamed as the Oracle of Omaha because he is a highly successful investor who lives and works in Omaha, Nebraska, USA. The nickname reflects the investment community's close attention to his investment decisions and market commentary, as if he possesses prophetic wisdom about the market. In this video, I will talk about 6 investment rules of Warren Buffett that he swears by. And you should follow these rules too if you want to emulate Warren Buffett's performance in the stock market. If there are 2 shops selling the same t-shirt, one shop is clean, busy and has been around for the last 20 years. The other one is dusty with no customers and has just opened last month. Which one would Warren Buffett bet on? The first one, always. Because Warren Buffett buys shares like most of us buy our favorite products, based upon quality, consistency and value. Warren Buffett sticks to a few rules for selecting a company for investment. Warren Buffett sticks to simple companies to invest in like Coca-Cola, American Express, Apple. He simply ignores businesses which he cannot understand even if that company is hot right now. वॉरेन बफेट कभी भी शॉर्ट टर्म ट्रेडर की तरह नहीं सोचते कि वो आज शेयर खरीदेंगे और कल अगर प्रॉफिट हुआ तो वो शेयर बेच देंगे। बफेट अगर किसी कंपनी का शेयर खरीदते हैं तो वो बिजनेस ओनर की तरह सोचते हैं और वो कंपनी के बिजनेस के बारे में हर एक छोटी मेट्रिक को इवेलुएट करते हैं। Buffett puts particular emphasis on buying simple, understandable businesses which are not susceptible to technological disruptions. For example, Warren Buffett didn't invest in any technology companies in the late 1990s during the dot-com bubble in the US stock market. Even when all technology companies in the US stock market were doing well at that time, he avoided investing in these companies as he could not understand their business model. Next rule is moat. A business moat protects a company from competition. Imagine a castle in olden times. To protect it from enemies, people used to dig a moat, a wide ditch filled with water around it, so that enemies can't enter the castle. The wider and deeper the moat, the harder it was to attack the castle. Warren Buffett uses this idea for evaluating a company. He says that a great business has a moat, something that protects it from competitors and keeps it profitable for a long time. He looks for moats which are growing or staying strong, one that competitors can't easily copy. Here in this video, I will give you some examples of business moats. Number 1 is brand power. Think Coca-Cola. It has a strong and trusted 140-year-old brand name. People prefer to buy it even when other soft drinks are available. Number 2 is cost advantage. Maruti Suzuki's focus on economies of scale and localization of production processes allows it to offer vehicles at competitive rates. Third point is network effect. Now these are powerful business moats where more people use a product or service, the more valuable it becomes for everyone. Think WhatsApp. If only 5 of your friends use it, then it's not very useful. But if your friends, family, office colleagues are on WhatsApp, then you have to use it too. Fourth point is patents or copyright. Patents or copyrights are like having a legal lock on your invention or creation. Only the company having the patent or copyright can use it, sell it or make money from it. This creates a moat or protection because competitors can't make the same thing even if they want to. Or the company can get a head start in the market without others competitors copying it. So patents and copyrights protect a business and helps it stay ahead like a moat around a castle. The fifth business moat that a company may possess is called high switching cost. It means that it is expensive or hard to stop using one company's product and switch to another company's product. A company with high switching cost has loyal customers who won't live easily even if a cheaper alternative is available. Think about Microsoft Office. Once a company starts using it, switching to something else is time consuming and costly, as the company's employees have to learn a new system, transfer all their files into the new system, maybe lose some features or data, so there is high switching cost. Buffett looks for solid profits before investing in the shares of any company. Profits are the money that a company has left over after it pays for everything it needs to run its business, like salaries, rent, raw materials and taxes. If a company earns rupees 1 crore in sales and spends rupees 70 lakh in expenses, then it has a profit of rupees 30 lakh. Now, Warren Buffett looks for solid profits before investing in any company, which means that more than just any profit, the profit should be consistent. That is, the company makes profits year after year and not just once in a while. The profits of the company should also be predictable. That is, the profits don't jump up and down too much. They are stable and secure. Also, the profits should be growing. The company's profits should be on an increasing trend year after year. Next point is well earned. Profits should come from core business, not financial tricks or one-time events. Now, Warren Buffett typically gives importance to these financial ratios while analyzing the financial statements of a company. Keep in mind that these are not hard rules but strong guidelines. Buffett will make exceptions if the business is exceptional in other ways. Also, all these ratios must be compared to their industry averages before selecting a company for investment. Warren Buffett only invests in those companies which are reasonably or fairly valued. A fair price is not necessarily a bargain. It means paying a reasonable valuation relative to intrinsic value, even if it's not dirt cheap. Warren Buffett's primary focus is on buying wonderful high-quality businesses at a reasonable valuation. He never compromises on the quality of a business to buy a cheap stock. Warren Buffett doesn't rush in and out of his investments in a jiffy. Once he invests, he is not in a hurry to sell. He believes in the power of long-term compounding and prefers to hold on to good businesses for many years, sometimes forever. Long-term investments benefit from the power of compounding. These are small gains which build upon each other and grow significantly over decades. Buffett bought Coca-Cola stock in 1988 and has held it for over 30 years now. The company's value and dividends have grown massively in this time period because of his patience and conviction of holding this stock for the long term. People have been drinking soda for over 100 years. The product is consistent, the brand is strong, and the demand is steady. Buffett understands how Coca-Cola makes money, so he feels comfortable investing for the long term. By sticking to simple businesses, Buffett avoids surprises. He doesn't get distracted by hype or headlines. He looks at things like, can this company keep making money in the next 10 to 20 years? Do I understand what makes this company competitive? Is the business easy to explain to a 10-year-old kid? Warren Buffett reads annual reports and listens to earnings con calls of companies to understand whether the management is transparent and candid, how they explain the performance of the company. Do they take accountability for poor performance? If the top management of a company sugarcoat any bad news, then he sees it as a red flag. Buffett respects straightforwardness from management. Buffett also looks into the track record of the top management of the company. He assesses whether the CEO, CFO, board of directors have a long and extensive professional experience of working in the same industry, and whether the company is performing well under their leadership or not, with high ROE, consistent sales and earnings growth. Buffett also checks the insider ownership and shareholder alignment of the top management. He assesses whether the CEO, CFO, board of directors own a meaningful stake in the company. He prefers investing in companies where compensation of top management is tied to increase in sales and profits of the company. Buffett also looks into the working culture of a company. He values strong ethical corporate culture. He often speaks with industry peers to gauge the company's reputation in the industry and whether the company is ethically treating all stakeholders like suppliers, customers, employees, etc. Warren Buffett's investment approach often involves going against the crowd, which is a key aspect of contrarian investing. He famously advises to be fearful when others are greedy and be greedy when others are fearful. This means that when the market is optimistic and everyone is buying, he becomes cautious, and when the market is pessimistic and others are selling stocks, he looks for opportunities to buy. Now I shall give you some book recommendations. If you read all of these books, then you will get a detailed understanding of the thought process and the investment strategy of Warren Buffett. The first one is The Essays of Warren Buffett by Warren Buffett and Lawrence Cunningham. This is a curated collection of Buffett's annual letters to Berkshire Hathaway's shareholders. It provides a straightforward explanation of his principles on investing, valuing businesses, and more, making it a valuable resource for investors. This is arguably the single best book on his investment philosophy. Warren Buffett and his partner, the late Charlie Munger, talk about their investment strategy and how they think about stocks in the annual general meeting of their company, Berkshire Hathaway. This book, The Essays of Warren Buffett, is a summary of those discussions. The second one is The Warren Buffett Way by Robert G. Hogstrom. This book instills a lifetime of investing wisdom into practiced guidance for investors seeking to emulate Buffett's long-term value-driven strategy. This book includes case studies of real investments Buffett made, like Coca-Cola, American Express, to illustrate how he applies his investment principles in practice. The third book is Warren Buffett and the Interpretation of Financial Statements by Mary Buffett and David Clark. This book focuses on three core financial statements like income statement, balance sheet, and cash flow statement, and how Buffett analyzes these financial statements to find solid companies for investment. Overall, the book teaches readers to read financial statements like Buffett, looking beyond the numbers to assess the company's true strength and investment potential.